everybody. Good afternoon. My name is Oliver Blokland, and I'm the Senior Conference Producer at Global Investor Group. And it's my pleasure to welcome you all to the ISF and ISLA Securities Finance webinar series. Today's session is entitled The New Regulatory Agenda, What might delays mean for buy and sell side firms? I'm pleased to see so many of you have joined us here today. I'd like to thank our 17 sponsors. Their logos were up on the holding slide for their continued support and who've made this event possible. Do please go to the Content Hub at the microsite where you registered to learn more about the Genuine Thought Leadership and view white paper materials. In today's 1-hour web conference, we'll have a panel discussion of around 15 minutes, and we have set aside some time at the end for Q&A. We have already received a few questions for our panelists. If you wish to ask a question, you can do so by clicking the Q&A button. Do keep sending through your questions for the panel, and we'll try to answer as many as we can by the end of the session. I'd like to take this opportunity to thank the speakers and moderator for sharing with us your time and thoughts on the topics we'll be discussing today, and the session is being recorded. It is now my great pleasure to introduce Michael, who will be moderating the session.
Hi, and thank you very much, ladies and gentlemen, for listening today to our panel discussion here on the new regulatory agenda. What might delays mean for the buy and sell side firms? Recent market volatility has raised a number of questions regarding the impact of coming regulations and whether the COVID crisis would derail or delay part of its implementation. Now, does the regulatory calendar still look possible, or is it now too congested for practical implementation? What guidance have regulators given for further delays, or how will they deal with the backlog? What would a CSDR compliant market would have looked like in a volatile first half of 2020? We would like to discuss these questions with my fellow panelists. We have Dr. Sven Kasper from State Street. Sven is the Senior Vice President and International Head of Regulatory, Industry and Government Affairs. As such, he is responsible for regulatory and government relations as well as policy development. He and his team monitor, analyze, and provide updates about all relevant policy and regulatory developments that may impact the economy. Then we have Dongyi Yin from MN, a Dutch pension fund manager representing the buy side with more than 160 billion in assets. Dongyi is a collateral and securities lending manager and focuses on collateral processes and securities lending. This includes all regulatory aspects, systems, technology, and innovation in this area. In addition, she's continuously striving to find efficiency for beneficial owners while incorporating ESG aspects in their investment strategies. And probably we also have time to discuss a little bit how COVID-19 has impacted ESG implementation. And then we have Martin Nahr, as a Managing Director from Eurex SDS, the buy-in agent service of Deutsche Börse Group. That's a relatively new role for him. Prior to this, he was Global Head of Funding and Financing and has been Managing Director at Eurex Repo from 1999 to 2019. Marcel has more than 25 years experience in the area of funding and financing, and he was instrumental in the establishment of Eurex GC Pooling. And then, last but not least, we have Mark Weston. He's working in the pricing, risk, and financial resource management team within the financing business of UBS Investment Bank. He's responsible for risk-weighted asset optimization for the financing business globally, and he's the equity finance product head within the business risk team. I'm Micah Cyrus. I'm heading up the repo securities lending and collateral trading activities at Ecker Bank. We are managing the securities lending programs for the German savings sector for their funds and other institutional clients. So welcome to this interesting session, and we would like to start with a polling question. So Oliver, if you could pull up the polling question. What would a CSDR compliant market have looked like in a volatile first half of 2020? It would have been more stable, less stable, or no change. Now, that was the question that I had in mind, so you already came up with the next question. But okay, then let's start with the question you just put up. So do you think that the regulatory reliefs and delays first release banks capital on banks' balance sheet that could facilitate credit intermediation from the financial sector into the real economy. So that is obviously the goal of regulators, to channel capital uninhibited from the financial sector into the real economy. Or second, release the burden on teams currently implementing the new regulatory initiatives. I think that's also an important point, to have every hands on deck to weather the COVID-19 crisis. Or three, just give the industry more time to challenge some of the proposed regulatory agenda. So A is all of the above, 1, 2, 3. B, none of the above. C, 1 or 2, or D, 2 or 3. So let us have your votes. Well, in the meantime, while people are voting, I can probably also describe a little bit the experiences that we had with some of the supposedly facilitations and simplifications from regulators. So in particular with regard to the LCR, but later on with regard to capital requirements. Because our regulators in Germany told us it would be okay if our LCR would come in below 100%. Now, that, of course, from our perspective, did make a lot of sense, given the initial freeze of unsecured money markets, and I could say yet again, freezing unsecured money markets. But consequently, our board just wanted to agree a change of a policy document in which steps were outlined that had to be effective in case the LCR would drop below 102%. That makes perfect sense in a world where you do not need to stay above 100%. However, when the joint supervisory team of the ECB understood what was going on, they intervened and told our bank that we need to tell them exactly why and when we would breach the LCR and how we would intend to heal any breach and ensure that the ECB was fully on board with anything that could happen. Now, that was kind of funny because the bank never had in mind to breach the LCR in the first place. We just wanted to ensure that all policy documents are consistent with existing regulation and, of course, benefit from a potential simplification. But quickly, the process became so convoluted that the bank decided not to change anything and not to make any use of the alleged regulatory release. As it turned out, also with regard to capital planning, postponing some of the capital charges, from our view, probably will not change too much, partly because these changes, these delays are considered transitory, and consequently, they probably don't have a long-term impact. But now, let's take a look at the results. So A, I think, is a clear winner. All of the above. So this means regulators are in a safe camp here, at least according to the participants of this call. So yes, the delays will allow the financial sector to channel more capital into the real economy, and it will release the burden of implementation with regard to all the regulatory initiatives, and of course, and we talk about this later, give the industry more time to challenge some of the proposed regulatory agenda. So I think that's probably a good outcome for banks and regulators. Now, let's just try to take a closer look in terms of what are actually the regulatory items that benefit most of a postponement or delay. So Sven, can you give us a short overview of the changes to the regulatory agenda that have been recently announced?
Yeah, sure. Thanks, Michael. And first of all, good afternoon, everyone. And also thanks to ISLA for inviting me to join this panel. I have to say, this is a rather optimistic crowd, clearly, given that 44% are assuming all three of these points will apply. Now, with regards to your question, Michael, around changes to the regulatory agenda, from my perspective, I think there's kind of three types of changes. One, there's some certain deferrals or postponements and delays that we've seen being announced over the last couple of months in response to the COVID-19 crisis. The second category is that because of COVID, there has been a general reprioritization of the regulatory agenda, at least especially in Europe. And then the third element is actual changes to rules that are already in place in order to address certain challenges or better prepare the industry and the economy for the challenges resulting from COVID-19. So if I take these three one after the other, in terms of immediate deferrals or delays, the most important ones, of course, on the regard to certain reporting requirements, such as Securities Finance Transaction Regulation, the SFTR, having been moved from April, unfortunately, only to September. I'm sure a lot of the industry would have liked a bit more, but that is clearly one delay. Other delays that I think worthwhile mentioning in terms of regulatory deadlines that have been moved around some of the money market fund reporting requirements that would have kicked in, DAX 6, which is cross-border tax reporting, and then last but not least, the initial margin requirement that was also postponed to next year. So that all has been seen as very positive. So in addition to those regulatory deadlines that have been moved, also some of the preparatory work for future regulatory change has been delayed or moved. In particular, consultations on global and UK level around operational resilience and outsourcing, which is quite important for the industry overall. But then also the consultations around MiFID II, the review of the AIFM directive. All of these have been extended, and through that extension of the consultation period, we're seeing a delay in the overall time frame of those initiatives. I'm going to talk about that a bit later. So that's kind of some of the, in my view, key changes, and of course also the CSDR changes that I'm sure colleagues will cover quite in extensive detail around the move of the CSDR settlement discipline provisions to next year's February. Now, that's the first category. The second category is the reprioritization, and I think it's fair to say policymakers in Europe were driven on the one hand by allowing the industry to deal with the current challenges, but also to allow for better preparation for the economic recovery. So things that have been changed is the implementation of the fine elements of Basel, so Basel IV, and which has important elements around the treatment of SFTs in it. That has been moved backwards. And then, as I mentioned, the AFMD and the MiFID review. While these initiatives have been moved somewhat on the back burner, what remains really center in Europe is ESG, sustainable finance. If anything, COVID-19 has moved that at the very center, and I think it's hard to envisage or foresee any regulatory initiatives going forward without ESG or sustainable finance elements. And then lastly, capital markets union. So that's the second part. And then to finish, the last piece is changes to existing rules in order to allow more flexibility, coming back to your initial remarks, Michael. So this so-called CRR quick fix, so changes to the capital requirements regulation, which are aimed at helping banks to weather the crisis and help the economy, and things like the treatment of non-performing loans, but I guess from a wider industry perspective, also the way a leverage ratio is calculated and central bank basins are being treated under the leverage ratio calculation have been quite important measures. So that's the kind of those three buckets I would mention here.
Okay. Now, is it? Yeah, or do we have to expect more freezes or more delays? Yeah. In particular, when we talk about potential second wave or anything like this. Yeah. So, do we see more lenience of regulators here, or what is your personal impression?
My view is I wouldn't bank on it this stage, because the view is, or the sense we're getting, the view is that while the pandemic's still going on, but has kind of slowed, that markets are in a better shape. Therefore, I think the sense of urgency amongst regulators has gone away. And hence, there's, I think at this stage at least, less willingness to further delay things. And we've seen this in response to the industry request to delay the shareholder rights directive. That was a very clear no. And also, I think there's an increasing sense amongst regulators that the industry is asking for delays on the back of COVID-19, but the regulators believe that COVID-19 is now used as a simple or easy excuse to ask for further delays. So I think the industry has to do a careful balancing act there. At the same time, now is actually the period for regulators in the industry to look at what are the lessons learned from the last months, and therefore what needs to be done and what can be done to improve the existing framework, and also what issues have been revealed through the crisis that need to be addressed going forward. So I think that's now the critical period we're in. But then a lot, as you said, depends on first of all and the way the economic recovery is going in the future months, which might ultimately force some more leniency, but at this stage, there's too many external factors on which that depends.
But will COVID-19 itself change the regulatory agenda, or is it something where you would say, no, this is kind of a one-off event, and now we're just staggering the implementation? Because after 2008 and the debt crisis in Europe, of course, we have now many years, and you could argue that the way regulation has changed has fundamentally altered the way markets are working and will work in the future. So will COVID-19 itself put a stamp on a new wave of regulation, or is it a transitory effect that we do not need to look into?
Well, I think it's somewhere between, because the big difference with the crisis now in comparison to the 2008 crisis, this is a health crisis that has created some problems for financial markets and for financial services. It is not a crisis that has been triggered by financial services. So I think that puts us in a better place and makes it very different. At the same time, I think regulators saw now this crisis as a useful occasion to actually use it as a test for the post-2008 financial regulation that was implemented. So has it worked? What are the problems? And so I think from that perspective, they are looking at this kind of what are the lessons and what needs to be, what can be improved, what not. And as I said before, it depends a lot on how the pandemic evolves, how the economic recovery evolves. And there's a number of factors there, I think, that are quite important. And I mentioned already ESG. So this whole shift to a greener economy is now seen as something that is a real opportunity on the back of COVID-19. Capital Markets Union is seen as something even more important on the European context. And then because of all what we have, what we had also experienced over the last month, operational resilience, outsourcing has become even more of a priority. Brexit plays into this, and how is that relationship going to evolve in the future? But then also, and the last point, the new ways of working. So, what does it mean when institutions have 90+% of their staff working from home? What does it mean from a regulatory perspective? What does it mean from a supervisory perspective? I think these are things that regulators are still grappling with and thinking about. And then lastly, I think from a buy-side perspective, this crisis again has raised a lot of questions with prudential regulators around, have we done enough asset management regulation? And is this something that needs to be looked at again, especially with regards to money market funds and liquidity management? So that's an area where we'll see more, but I'll stop here.
Okay. And something where we actually see kind of an old style response as part of the COVID crisis, obviously, were short selling bans. Now, in securities lending, of course, short selling bans are something that has to be considered. Did you think that this did help the markets this time? So I think it's kind of a regulatory response that we always involve when markets are going down. Did this help?
Well, so I think there's two things. On the one hand, it's interesting that it was a relatively small number of regulators that established these bans, but at the same time, it was similar to 2008, an almost instinctive reaction by these regulators. There's market volatility, let's put a short selling ban. Has it worked? I mean, colleagues are much closer to the real market, so I let them opine this. I don't believe so, simply because the problem in the market volatility and the market reaction wasn't driven by short selling, or it was, if anything, by establishing these bans, you take out potential additional liquidity from the markets, and also you take away a pricing tool within the market. So from my perspective, it's been rather counterproductive. But I'll let others comment on this.
Dongyi, what is your perspective from a buy-side perspective? Do asset managers like short-selling bans, or how does it work?
I think that we don't have any evidence that the short-selling bans work very well. I mean, we haven't seen any strong evidence that the market with short-selling bans, that they perform better than markets without the short-selling bans. So we do see that short-selling bans, they mostly lead to a decrease in the trading activity and also an increase in trading costs, so which can even lead to slower recovery of the pandemic. So in general, we believe that short selling is supporting efficient price discovery. So short sellers, they do their homework well, and they only short overpriced securities, according to them, of course, or companies with questionable accounting or activity. So I think the very recent example is Wirecard. So in the end, we don't think that the short selling bans really work very effectively.
I tend to agree. I'm sure Marcel, as a buying agent, you have a view on that, or?
Well, as a buying agent, of course, I will explain later during the panel, but the buying agent is buying in the securities from what we call network partners, which are the sellers in the auction. And from them, we buy as a guaranteed delivery in that sense. So these securities have to be on an account already before getting sold. So from that perspective, the buying agent is not in that position. But generally, as you know, the short selling ban was not introduced in Germany, and Deutsche Börse was publicly and in the press very outspoken that we supported the covered short selling of equities and market, and therefore everything must continue to be possible in order to give asset managers, and this is the buy side, full flexibility to use their assets in the market in times of strong price fluctuations. And this must be more than just buying and selling as it was the case in the past. They must continue to be able to use these assets to their full extent, for example, to lend them out to generate liquidity, which I think is what Donji said before, for the lending market, very important that there is still liquidity in the lending market, and I think that speaks for itself.
Right. Yeah, I think it's always easy to get an agreement within the market professionals, and then we find out how difficult it is to explain your grandma or your parents what short selling actually means. But let's go back a little bit to SFTR implementation. Dongi, what is the buy-side perspective relating to the delays and the general level of preparedness? Is SFTR a done deal, or will we still be talking about this in 21, or how does it work?
Yes, first I will start with a short introduction of SFTR for everybody. SFTR is introduced by the EU. It's called the Securities Finance Transaction Regulations, and it was meant to increase the transparency across the SFTs, so the securities financing transactions. So SFTR is a two-sided reporting requirement for both the borrower and also the lender, and we are all required to report our side of the SFT to an approved TR on trade date T+1. In general, I think it was positive that we had a delay for phase one participants, because most of our borrowers, they are phase one, they belong to phase one, and they could use the extra time to for the parallel testing and production, and also fix some hiccups in the beginning of the process. So we think that this delay has also indirectly been useful for the phase three, like the most buy-side participants, because the borrowers had more time to prepare and test their SFTR process, and we have more confidence in a smooth start in October. So I think we are all well prepared, and I think that SFTR should be a done deal this year, because in a week time, phase 1 and 2, they have to be SFTR compliant, and most of the phase 3 participants, they are already preparing for a while. And yes, I don't see any big challenges for another delay. However, I will always say that if nothing unexpected happens, we never know. In the meantime, I believe that SFTR should be a done deal this year.
Okay, that's also good news. Yeah. So are there any kind of key issues that you would actually see where people are struggling, also in the area of matching ratios and these kind of things, or is it something where you just say, okay, it's ticking along just nicely?
To be honest, I don't see any key issues. That's also the reason that I believe that we should be ready for SFTR this year. We see that phase 1 and 2 has already started with a parallel testing, and they don't have encountered any blocking issues.
Right. Okay. No, that's good. And is there any kind of a Brexit fallout from an SFTR perspective?
I think so, because I read somewhere that UK has issued a statement which contains an announcement that they are not going to apply SFTR to the non-financial counterparties, which are the phase 4 participants, and that has to start in 2021. So I think that this will be well received by these firms, because if they don't have to be SFTR compliant, they are not, it's not necessary anymore for them to purchase any additional system or services to be compliant. So, I mean, in the end, regulatory obligations can sometimes be a burden for some parties.
So does the Brexit then give rise to a competitive edge for UK firms?
What did you say, Michael?
Does it give a competitive edge? So if you don't have to be compliant, does it give a competitive edge?
I wouldn't really say that. I think it's more relieving them from a regulatory burden, and it can save them some money. That we can be sure about it, because all the systems and services can cost some money.
Right. Yeah, Martha, and I think that is already a good introduction to CSDI. Yeah? So because obviously we had a couple of interesting statements from the UK Treasurer saying something about CSDI implementation, in particular with regarding to mandatory buy-in. So what is the mandatory buy-in regime all about, and why is it important in the first place? If you can give us a short intro to the topic. Yeah?
Yes, thank you for the opportunity to be here, and thank you, Michael, for the question. I think it's important to outline a little bit what mandatory buy-ins and buy-in agent means. In that sense, it's important to understand what Sven already said. SDR is a settlement discipline regime, and mandatory buy-ins come within the settlement discipline regime, and it will and should enforce settlement efficiency and operational efficiency. And I think this is important. I mean, you said it at the beginning. My background is more from the trading side, and I've seen what happened all on the trading side for all these years on efficiency, but probably it's lagging more on the operational side, and I think that's probably the biggest challenge. And I will outline that a bit later, what we see there, the people doing. So having said that, how does it work? We have today already in most bilateral contracts optional buy-ins, and I say optional because it would be in the contracts, but it's often not really executed. One of the main reasons is also the burden of the relationship you have with the people selling you the assets and the securities. And if you're an asset manager or a pension fund and you have a great relationship and you want to keep this great relationship, you probably don't immediately ask for a buy-in and actually force that in that sense. And I've saw that previously in my role on repo, that it actually didn't happen that much, and smaller counterparties didn't want to force that at all. So I think it's around, but it rarely happens, and it's often not successful if it even goes to a buy-in request on that side. And I think that makes the difference. If you're talking about discipline and you would like to bring efficiency somewhere, you probably need to have something which hurts, that it hurts. It often comes with costs, and probably that something needs to happen. And if you say how it works in the new model is that the buyer must request a buy-in request to the buy-in agent. And here comes, I think, the interesting part, and I think that often is also not seen in the right way, because you have 4 days after the settlement was not efficient or was failing. You have 4 days after that you go into for liquid equities. The buy-in request has to be done by the buyer to the buy-in agent. Then 7 days after that the fail happened, the actual equities and less liquid equities and fixed income products will be for the buy-in. And then 15 days is then for SME growth market equities, which then have to be bought in that case. And we actually then do an auction and buy it in from sellers. They're selling us their market makers and so on, their brokers, and there can be also asset manager which sell us these securities. And then we pass it on. The buying agent doesn't take any position differently to some other market participants. They're brokers in that sense, or broker dealers, and that's where we have no conflict of interest in that sense, that we are speculating with these positions. We just pass it on to the buyer at the same price, and the buyer then actually can claim the buying costs to the original seller. And I think that's quite an important part, that this gets more mandatory, that settlement discipline can happen, in my opinion.
Okay, so but what do you think is the general level of preparedness for CSDR? Are people already there? Yeah, is that something that that you just switch on and then you're done? Or?
Well, it's not actually that. I mean, because it's about settlement efficiency, what we realize is that we offer in a buying agent that a lot of people pass by and ask a lot of questions about also optimization, settlement efficiency, how these things can work, and how the process work, and what they can do. So they share often information with us on current level of fails and what potentially would then be in a buy-in agent situation. So the preparation is quite interesting. The ones they do the homework best and they are really well developed, they probably being ready by year end. And I think this is about the third of the people contacted us, not the whole industry, of course, but the people contacted us, which is a wide range already. And we see clearly they are really working on it, and they're working also on settlement optimization tools and settlement efficiency tools also to go in this direction. And interesting for me is as well that some of these guys, I mean, we thought that it's probably efficiency coming pretty quickly before the mandatory buy-in situation comes into place by February 2021 now planned, that by then settlement efficiency could be easily already by 75%. We see that bigger banks already plan for being ready for 90%. So it's quite interesting to see. So if they actually change their processes and operational processes internally, there might be more efficiency in there. So it actually already works in terms of preparation, that settlement efficiency will be implemented in that time. But I think mandatory buy-ins and the risk of mandatory buy-ins probably helps here to put the pressure on. The second group of people, are the ones, they actually just preparing, they're coming to us to ask questions, and then it's the first group of people, of course, they haven't started yet really, and just ask for the simple questions, how will it work, and is it really necessary and mandatory for me?
Yeah, no, regarding the question whether it's necessary, I think the UK has given an answer to that from their own perspective, and I think the UK Treasury announced that they will not implement mandatory buy-ins. And does it mean that UK firms are exempt from mandatory buy-ins at all?
Well, not at all. But UK Securities settling trust in the so-called domestic market, they will indeed be exempt, and from mandatory buy-ins. However, all securities settling in European CSDs and ICSTs will in scope for mandatory buy-in, irrespective where the trading counterparty is sitting in the world, and therefore it's mandatory for them. And I mean, I saw several figures. I don't know which one is true, but 25% of the activities, whether it's trading volume or settlement volume, was not given in that information. Is in domestic, and 75% of the activities are outside of the UK, more in the European space, of course, and international. So it's probably a bigger bulk of the business, which is still part of this mandatory buy-ins.
So UK firms that are dealing with European securities would be also subjected to mandatory buy-ins. Yeah? So and okay, that's quite interesting, because I think that there could be a question in terms of do we have a level playing field in terms of competition here if the UK is exempt from mandatory buy-ins, and if there's also a different regulatory regime, how would you see this kind of quite early divergence, which I think can only happen if there's something like a very quick Brexit as well.
Yeah, absolutely. It's probably the first examples how Brexit could look like, and how actually things can be perceived. But as you know, I'm Swiss, and I'm actually also was for a long time being responsible for a repo market domestic in Switzerland. And I just would like to say this is also, if you look into that, what's happening in Switzerland, which is for a long time had their own regulation for domestic markets, but also a lot of market participants using, of course, the European market and being participant in the European market. And guess what happened? Whenever we try to do something with our participants, or was it the market infrastructure side, if we try to do something in settlement or efficiency, you have to always scope with two parts of the regulation. And the gaps can be quite, I remember of MiFID II and FIDLEX Switzerland, the gaps sometimes can be quite amazing, and you have to figure that out and what that means in processes and implementation, and there are costs involved. So taking the questions earlier, you said, yeah, maybe they save a little bit on not implementing SFTR on one side, but having these gaps is not so easy to follow up in the future. And just knowing that by doing that done that for 14 years, I think it can be very challenging. So that is clearly a disadvantage at the end.
So, but actually, you say it could probably be a disadvantage rather for the UK, because they have to operate two different standards rather than for the Europeans. Okay, I think that's an interesting perspective. I think some of the discussions regarding the CSDR point to that the implementation of the CSDR will take away liquidity from the market, because currently you of course have market makers, and they can actually make markets, and the traders can make markets without actually caring too much whether they have the shares in their inventory. So which they argue probably would allow for tighter bid offer spreads and smarter and faster execution. What is your view on that?
Well, as an ex-trader, I wasn't really involved in that, and I didn't really care. But now being involved in the buying agent and having seen much more what's going wrong in the back office, and that people, I mean, look at the technology, trading technologies out there with algorithmic high-frequency trading, getting servers down to the exchange seller, very close to the server, and getting every milliseconds and everything out at one side. On the other side, the back office still works like 20 years ago and hasn't done a lot on that side. So this efficiency, I think, is good coming in on that side, that people focus more of what can be done in that level. And the liquidity, I'm not sure, is it right that somebody sells something which then actually is not really available? And if I look into an example for, let's say, a pension fund, because we have Tongi here, just sorry to use that, we have a pension fund buying a security, and in the current environment without mandatory buy-in, it takes days whenever it would come to a buy-in. And then let's say the broker goes bankrupt in such a model and would never actually sell that. So the pension fund has to buy everything again and has all to share all these costs because it took forever and nothing happened. And in such a case, we as part of pension funds investors, we would actually not having the performance if this equity or whatever would even have performed well during that period. It was never actually delivered. So these kind of things, in my opinion, are not good for a capital market in that sense we are looking for. And so, yes, it might have effects, but what I heard as well, and this was interesting, and then I'm done on that, interesting that somebody mentioned, and it was a US-American bank in London, was actually mentioning that they looking into that, who is not delivering when they buy things now on time. So what does that mean? I'm an old money market guy in 25 years ago. It happened already in cash. You need it for liquidity management, and you have to have the requirements for liquidity. And if that happened in cash, then you said, I don't trade with this counterpart any longer. So it seems to be on securities transactions, this will happen maybe as well, that you don't want to deal with participants any longer if they can't deliver securities on time.
Tongi, I think that is one shot at your side. So from an asset management point of view, you like CSDR, or you're in the camp of those people who think that this is a nuisance, or make probably execution more expensive, or you did not make up your mind at all?
We're still reviewing as CSDR. However, to be honest, every extra regulatory obligation, I'm not a very big fan of it. I mean, if we're looking at CSDR, and we also had a question, what would happen if it was already, if we have to be CSDR compliant in the first half of 2020, I think it would be, kind of a chaos, because you have the mandatory buy-in, you have the cash penalties, and if the market is very volatile and we have some illiquid positions, yes, I'm not sure whether it's going to solve a lot. I think at this moment we see a lot of challenges, and we have to review it very thoroughly with our legal department. But at this moment we're not very happy to receive CSDR.
Okay, Martha, I think there's still some persuasion, lessons in persuasion. Yeah, so you most likely pick up the phone after this panel discussion to Dongyi and tell her all the benefits of the CSDR introduction. Yeah, but CSDR, of course, these are important regulatory initiatives. The other part, which obviously is important, is all the three kind of things when we talk about additional capital, fundamental revenue of the trading book, and how RWAs impact securities financing going forward. Yeah? And we have Mark here on the board. So can you describe the upcoming changes to prudential regulation impacting banks' capital requirements?
Great, and thanks for the introduction, Michael. So the Bank of International Settlement published a set of Basel III finalization rules, commonly referred to as Basel IV, and these relate to bank capitalization applied to all banks conducting business in European markets. The most potentially impactful of these new rules to the SFT business is the introduction of these risk-weighted asset output floors. So essentially this requires that a bank's risk-weighted assets be floored at 72.5% of a new standardized risk-weighted asset calculation. Now, in their current form, this standardized calculation is particularly punitive for SFTs and would likely be material enough to make this floor the binding constraint and then hence drive a material capital increase. These rules were due to go live in Jan 22, starting with a floor at 50% and then going up to 72.5% in Jan 27, but these dates have all been pushed back a year in response to COVID-19.
Okay, that's a good thing. So how does it currently work? Because I understand that SFTR, securities financing transaction and lending, this is always the sweet spot in terms of return on capital. Yeah. So currently, obviously, we have a quite benign treatment of repos and securities lending and all these kind of transactions. So how does it work today, and what are the new changes?
Yeah, so right now, I think most banks are probably under an advanced approach for RWA calculation. So if we look at the credit risk RWA calculation, which is the main one impacting SFTs, it looks to calculate the potential exposure a bank could have to a counterparty in the event of their default, and then it multiplies this by a risk weight, and that's derived from the probability of the counterparty defaulting and the expected recovery on any residual unsecured claim. So if we take the average stock borrow loan counterparty, and these numbers are all kind of just averages, the current credit risk RWA is about 3%, so about 3% of the notional of your trade, and this comes from a kind of 25% exposure at default, which is your haircut plus any slippage unwinding your trade, and then that's times by your typical risk weight of about 12%, and that kind of reflects the good, strong credit profile of the counterparty we generally deal with. And then the cost of that, the capital you need to hold, is about 1%, which comes from the theoretical cost of raising the capital and the amount of Tier 1 capital you hold. So when you put those together, the 3% RWA and the 1% cost of RWA, you get to about 3 basis points right now for your typical SBL trade. So if you look at the new calculation that's coming in, this standardized calculation, it's particularly punitive for two different elements. So firstly, there's this introduction of minimum haircuts. So essentially, this prevents you from using the assets that you hold as credit mitigation in the exposure at default calc if the haircut that you receive on these assets is below the thresholds they outline in the rules. Now, the slightly crazy thing is that obviously as borrowers always pay away a haircut, they will always be below these thresholds because these thresholds are above 100%. The second one is the removal of an ability to rely on internal counterparty risk weights. So in Europe, we kind of use our own internal models to rate our counterparties, but that goes away and you can only use ratings that are provided externally. Now, a large number of clients that we deal with, particularly through agent lending, are kind of funds and people who won't have an external rating because they haven't got any debts, they don't need one. So all of those guys would end up going to 100%. So if I put a few numbers against some of these impacts, and there are some kind of crazy numbers here, the minimum haircuts would see all your exposure defaults go to 120% through the exclusion of the borrower, so that's a 5 times increase to the 25. And the removal of the internal ratings would see your risk weights going to 100%, so that's an 8-fold increase. So if you put these two together, you end up with a 40 times higher standardized RWA than the current approach. And if you use that kind of 72.5 weighting, that average cost of an SBL trade I was talking about goes from 3 bips to 90 bips. And if you take it up to a total business level, if you've got a, say, 50-yard borrow book, the increased cost of RWA capital will be about $450 million a year, up from about 15 today. So clearly at those levels, it's enough to make most financing business uneconomical if the rules went live as they are today.
Right. I think that's a very interesting point, yeah, because I think, as said, when we are doing, for instance, securities lending and repo type transactions, then we are always being asked for the return on capital. The return on capital usually is something like 60%, 100%, and in some instances 180%. Yeah, and on that basis, we always make a point that this is a very good additional and actually also not risk-free, but low-risk type of additional yield on what you can do with your securities. But what you're actually saying is that if things stay as they are, then at some stage we actually would have to see this type of business, not because so much of the cost, but the point is I think nobody would be prepared to put so much capital into securities lending activities as would be required according to these new standards, right? So how long? So this has been pushed back by 1 year, or and then actually you have to implement it. You say by 2025, I think, and 27 are the respective guidelines, right?
Yeah. So there's a couple of bits of good news, I guess. So firstly, I guess there are a couple of solutions out there that are kind of already in flight. And as you say, the delay is kind of helpful. It's pushed the implementation date back to Jan 23. And then the final, because this floor goes up and up, but the final kind of legging in is 28. So there's quite a lot of time till the end, but obviously this first point is quite relevant because at that point the numbers start getting quoted, and we all know when these numbers start getting quoted, management start getting excited and making decisions. So I do think this Jan 23 is relevant. So I talked to the couple of solutions out there. So the industry efforts so far have really been focused on addressing the minimum haircuts. So these just don't appear appropriate to apply to borrowers as the haircut payer. It just doesn't really seem to follow. So ISLA have been very engaged on this, and there's already been good traction with some regulatory bodies. So ESMA and certain people have already come out effectively in favour of revising these part of the rules. So I think this one's on the right track already, and as an industry, we just need to keep pushing this until the rules get formally revised. The removal of the internal counterparty risk weight, on the other hand, has a high potential impact. It's far less likely to be changed by regulators because I guess it's what they're trying to achieve. And to date has had far more limited industry focus. So there's definitely one to think about. As I see it, there's 2 routes to solving this. So one option, you go via one of your already approved external rating provider, i.e. one of the traditional rating agencies. Now, while that's possible, there is a lot of work there, which is kind of time and cost for both us and them, because they've got to come up with methodologies, assess the most material funds, and then keep all that up to date. The alternative we've been looking at is using this idea of an aggregate ratings provider. So they already have ratings for the vast majority of our agent lenders. So the way they work, they just work with kind of all the major banks, and everyone submits their own ratings, and they kind of aggregate them and get you a kind of, they create a non-biased external rating from your internal ratings. So I guess the beauty of that approach is they're already ready to go today. The one thing they need to get is approved as an external provider of ratings. So I guess the heavy lift is on their side. So I guess good for the industry and probably good for cost. So there was a recent roundtable hosted by ISLA, attended by a lot of industry participants, along with Credit Benchmark, who are one of these aggregate rating providers. And it was agreed that Credit Benchmark, with ISLA's support, will take this initiative forward, and they'll look to become an approved external rating provider. So again, if we get good traction from them, I think that'll be a great solution. So I think Jan 23 is the date we really need to hit. We've got both these in flight, but I think we do need the whole industry behind this and pushing these to make sure they get done and remove the potentially punitive impact of some of those kind of crazy numbers.
Just for me to tell you, I think we also, as a bank, looked into this, and I think we came out with all the other hope stuff that we would have to come up with 20% more capital, which is also for a bank like us, it's quite significant. What you're describing, that actually is particularly relevant if you have an unrated counterparty, right? So if you have a rated counterparty, which is probably a part of the business model for many of the repo sec lending counterparties, then this would not be as punitive as you just described. Right?
Yeah, exactly. So all your interbank stuff is fine. All us big banks borrowing off each other is fine. But as I say, I think in our world, about half of our business goes through agent lenders, and I think almost all of those guys won't have ratings because they just don't have a need to today. So that's probably half your business that would be impacted by this. And as I say, it's a pretty extreme move from kind of, because the thing is they're all well rated. I guess that's the point. Yeah.
I think that's a good point. Yeah. So what you're actually saying is that if this actually kicked in, then we do not need to worry about SFTR and CSDR implementation any longer because these markets will not exist then.
Yeah, we at least won't need to go back to the office again. Yeah.
Okay. So, and I think with this, we're more or less at the end of our panel discussion, and we have a couple of questions. And please, everybody in the audience, if you like to shoot up some questions, do it now. We already have a couple of questions which I would just read out loud. So I think that one of the first questions is: are banks better prepared due to post-2008 regulation? So the 2008 regulation had such a positive impact on banks that we are now so much better prepared. I think, Sven, I would like to hand this question over to you, and then everybody just jump in if you feel.
Well, that's a poison chalice as a question. I think it's very dangerous. But anyway, so I think it's a mixed picture. I think to some degree, I think from a supervisory perspective, yes, because simply banks have to hold higher levels of capital, which made regulators and supervisors far more, shows they were far more comfortable with how the industry was doing throughout the crisis. So from that perspective, yes. But I do think what the crisis has also shown, that's one of the things with regards to lessons learned, where also more analysis needs to be done, is some of the issues that happen in the markets when it comes to shortage of market liquidity, unwillingness to make markets, is a result also of some of the regulations that were implemented post-2008 and the related capital requirements. So I think it's a mixed picture. There's no clear yes or no to this one, and I think it does require the work, and I think there will be some tweaking afterwards.
Okay.
I'd add from the capital angle that I guess what people don't see, people see a lot of the tier 1 ratio movement. So a lot of banks had kind of, 4 or 5% tier 1 capital ratios pre-08, and they're now more at like 10, 12. But I guess what people don't see is that the actual underlying RWA calculation, even today's, is probably 3 or 4 times more conservative than it was back then due to all the calc. So I guess to the outside world, banks look 2, 3 times better capitalized. They're probably 10 times better capitalized, really. And we saw that in the reaction of bank CDS spreads. I know it's a different crisis, the one we've just gone through, but bank CDS spreads were hardly moving. Everyone was sub 200, like some people were sub 50, like it really didn't move compared to 08. So different crisis, but yeah, I definitely think from a capital point of view, we are way stronger. And I don't think that the kind of general public appreciate how much stronger we are than we were then.
And I think I love that point because I also think that this is clearly one of the most underappreciated issues that we have in the market, that for once you have raised the bar, so that everybody has to come up with higher tier 1 and capital numbers, but at the same time the way we calculate capital has become so much more punitive that in essence for the same type of transactions we also have to reserve more capital. And this is actually why I would fully agree that the capital or the amount of capital industry is way higher than numbers currently would actually tell us. Now, I think there's another question. If we accept that we need to create a more efficient post-trade environment, would we therefore argue that CSDR is a good piece of legislation? Okay, Dongyi, Marcel, I think you already had a little bit like an exchange on that question, but perhaps you would take that up. So it's a good piece?
Good piece.
Yes. I think all regulations has been created to have some benefits for the financial market and all the participants. And we still have to review the CSDR. We kind of postponed it because we were more focusing on SFTR, and CSDR. It's still we still have to create our view. But I think if the post-trade environment would be more efficient, that of course that would help, because if our system is more efficient, we are, it brings less burden for us.
Right.
So yes, we are still working on our view regarding CSDR.
Okay, we have one fan, I would say, who's even confident enough to make a business out of this, and we have one guy on the panel who's probably not 100% convinced. Yeah. So, and then we have another question on CSD. Is there an overlap with EMIR, which will create uncertainty? And we discussed already questions regarding the impact on liquidity. So, is there an overlap with EMIR? I'm not sure. Yeah? There's something, Ben or Marcel, are you aware of that?
Well, I'm not sure, because CSDR, if you're talking just about mandatory buy-in, this is one piece. I can say, well, there is already rules in place for CCPs, how they have to deal with it. And I don't see there any issue on that side, because we will actually do these kind of buy-ins as a service for the CCP or ex-clearing at the end. So they might have their own rules, but it corresponds with the processes. So they have done their auction processes already today. So I'm not sure in which direction the question is going, but any other I don't see.
Okay, then we have had two questions, and I'm told these are the last questions then to Mark. First, would the unrated counterparty problem solved by using a CCP, and how would you treat a central bank from a rating perspective?
Yeah, thanks. That's a good question. So the unrated counterparty problem, so CCPs definitely help. They have a far better risk weight. I think they're somewhere around 2% or something. So yeah, obviously way better. Again, I think the simple solution is to get everyone rated. Putting everyone through a CCP is quite difficult, but it's definitely an option if we face problems going down that route. The other way, which you're saying, again, we're kind of pushing industry-wide, is this whole moving to pledge from title transfer collateral. So if you pledge collateral via the tri-party agents rather than title transfer it, you remove your counterparty risks, you also remove all your RWA and all your LRD. So it's a huge one right now from a revenue perspective that we're really pushing. And again, it would help solve this problem. If you remove your risk, it doesn't really matter anymore. So there's definitely a couple of other options out there, but I think with the time frame you've got, moving all industry participants through one of those approaches is difficult, although they should be pursued. I think some generic approach to deal with everyone is probably good. And central banks, it depends. I think some of those you can get like a zero risk weight. You can be risk-free with a central bank, but very well rated regardless. I haven't actually thought or heard of that one as an actual counterparty to trade through, but again, it's another option. I mean, all these solutions of dealing with lower risk counterparties. I think the last point on it really is that the counterparties we deal with now are already quite good. They're already quite low risk. And what we don't want is a new regulation coming in that artificially makes them look really high risk just to issue some technicality. So any way to resolve that technicality, I kind of don't think we face particularly high risk counterparties right now. We just need to make sure it continues being reflected like that.
Okay. So thank you very much then everybody, and in particular to my fellow panelists. Yeah, so Sven gave us a great overview and his idea of how COVID-19 has impacted the regulation. Dongyi actually told us a little bit about SFTR. Marcel elaborated on the CSDR regime, and Mark actually told us that if you don't get the output floors right, there's no need for SFTR and CSDR in the first place. So thank you very much. I hope you found that interesting. And I give back to our moderators. Thank you.